So we're going to do something a little bit differently this week, folks. Normally when we do these webinars, I'm the one that presents, but today we've got a special guest, Kimberly Lips from John Hancock, who's going to present. They've just come out with a product recently that I really think is going to be a definitely a strong arrow that you need to have in your quiver when it comes to talking about long-term care insurance. And I'm going to tell you something that I start almost every webinar with, whether you're in the long-term care market or not. And I'll say this about annuities and life insurance, whatever business you're in, whatever products you're selling today, what we're bringing to you folks, your clients are buying, I promise you. We want them to buy it from you. So that's why we try and stay in front of you with educational things, arrows that you can add to your quiver, because you need to have this stuff in your portfolio because your clients are buying it. The demand, long-term care, believe it or not, is not my favorite product to sell. I like long-term care insurance, but coincidentally, what's bringing me toward long-term care so much lately is not my desire to sell it or my love for the product. It's the demand that the industry is bringing us. And LIMRA told us this a few years ago when they ran a study that said people that are turning 65 right now, there's a 70% chance they will need some form of extended care in their lifetime. Well, that means if you take 10 people and stick them in a room together, 7 of us are going to need it. So Kimberly is going to show us a solution today and how we can apply it. And I would encourage you to call us. My phone number is on here, my direct line, 913-568-2040. You can reach out to me anytime with questions if you need quotes. Keep in mind as we go through as well, you do not have to be the expert in long-term care. If you need help with this, you can utilize us through our split case program. We'll be happy to plug in there and get you up to speed on that as well. So with that, oh, by the way, lastly, we did block off an hour for this webinar, but the good news is we're not going to take an hour. I've only taken 2 minutes so far. Kimberly's going to take about 30, and then we're going to leave the last part of the webinar open for questions and answers. So you can stick around if you'd like. If not, you're free to go whenever you want. But I'm confident that the information that Kimberly's going to bring you here today is going to keep you here for at least the 30. So with that, Kimberly, I will stop sharing my screen and let you share yours, and you can take it away. But you might want to unmute yourself first.
All right. Thank you,
There you
Aaron,
go.
and thanks for letting me join the call today. Let me get my presentation up here for all of you to see in a better format. There we go. All right. Well, I always like having these long-term care planning conversations. We have rebranded this and modernized the conversation a bit. We're calling it longevity planning, right? And you'll learn as we talk a little bit why we've modernized the hybrid conversation a bit with some of our terminology and then also some of the features that our product has to offer. But my dad lived with Parkinson's for 18 years before passing away 9 years ago. So I get what the long-term care world looks like from the consumer side of things. And so definitely passionate about helping you have conversations with your clients. And it definitely is important to plan for long-term care. It's essential for your clients, their family and their finances. And I'm sure you probably already know that, or else you wouldn't have joined the call today. But why it's important and why it's a problem is long-term care is expensive. There's a cost of care study out there that shows that long-term care costs, in particular home health care costs, over the past 3 years have been going up at an annual rate of 10% a year. That's significant and about double what facility care costs have been going up. Yet, of course, we know that that's where our clients want to receive their care. And we know that that's where the insurance carriers are paying out over 50% of claims across the board are being paid out for home health care costs. So definitely that's a reason to have conversations. Also, an important reason to have conversations is because those long-term care responsibilities typically end up falling on the family members if there's not a plan in place. And when family members provide care, they end up, 70% of them end up suffering from depression, not to mention, physical injuries and illnesses as well as a result of being that caregiver. And then certainly long-term care and long-term care spending are concerns at the state and the federal government level. You may all be familiar with the fact that the state of Washington was actually the first state to implement a payroll tax, and there are definitely other states considering rolling out some sort of a program like this. So enter LifeCare. Before we actually developed the product, our leadership team had a team put together to go out and survey some of the largest distributors of hybrid products across the country. And there were a few asks if we were going to roll out another product. They said there's room for another carrier in the space, but hopefully it would look different in 2 or 3 different aspects. One of those was a better way to address the rising cost of home care. So these are our 5 pillars of more that LifeCare provides. And let's just start out with number 1, and that is the more when it comes to growing the benefits and helping to address that rising cost of home health care. So we have put this on an IUL chassis. And not only do the long-term care benefits grow, but the death benefit grows. So that's definitely going to be different than what you're used to with the other hybrid products in this space. So year 1 benefits, our benefits will be similar to our peers, but you're just going to see that that death benefit is going to grow unlike our peers in this space. So while it's on an IUL chassis, unlike our traditional IUL products that we offer at John Hancock, this one is guaranteed to age 125. So it does have that lifetime guarantee on all those initial benefits. And then as the benefits grow, right along with performance of the S&P 500 index, what you're going to find is that those benefits also receive what we call our annual benefit lock guarantee. So once there's a credit to the death benefit and the long-term care benefits, as a result of that growth, it is locked in automatically. Nothing that you or the client need to do. It's automatically locked in and guaranteed to age 125. Second pillar, more healthy days. That's the Vitality story. Some of you may be familiar with our wellness program of Vitality that we offer on our traditional life products. We have automatically built that in on this product, and that is another way for your client to engage in the policy and actually receive credits to the death benefit and the LTC benefits on an annual basis by engaging. Earning points is exactly the same way as you may be used to with Vitality on our traditional life products, and all the other rewards that come with Vitality that you might be familiar with are also available on the LifeCare product. The third one, more choice. We're definitely offering choices. And one of the asks, again, from the field was that we offer both indemnity and reimbursement on our product. The nice thing is you don't have to choose up front. The client gets to choose at the time of claim which way they want to receive benefits. By default, we have indemnity as the default. We will pay indemnity benefits up to the IRS per diem limit. If from day one the client would prefer a reimbursement model, certainly they can elect that. There is no charge for electing indemnity or reimbursement. So if the client has a monthly maximum benefit of $10,000 a month, they'll receive $10,000 a month, whether they choose indemnity or reimbursement. And again, that is going to be a little bit different than what you're used to seeing out there with our peers that might offer both as an option on their product. We do offer a single pay, a 5, a 10, and a 15 pay premium option. Something that is notable, we do not have an age cap on our 10 or our 15 pay. So you could have a 70-year-old, a 75-year-old who's actually electing a 15 pay premium model. Let's pivot over to number 4, more tax favored treatment. There will be more to come on this in early May. Our advanced markets team has put together a tax guide as well as a couple of pieces targeted at business owners. And so the one thing I want to point out for pillar number 4 is that we have included a separate identifiable long-term care premium for that tax deductible opportunity, both for business owners and then also for pulling dollars out of maybe an HSA or FSA account. Number 5, more experience and support. That's just simply the John Hancock story. Not only have we been in business for the life insurance world for over 160 years strong, but of all the carriers offering a long-term care solution today, John Hancock has the longest history in that space, just about 40 years now in the long-term care solution space. So when it comes to claim time, we have quite a well-oiled machine. We have an online portal for submitting claim forms. forms and uploading documents. All of our claims administration team are based in the United States. We don't outsource our administration team for processing those claims. Everybody is a John Hancock employee. So that can be a differentiator when it comes to actually needing care and wanting to pull benefits out of your policy. All right, so let's dive into a few more details regarding the policy. At the very top, I do want to point out that LifeCare is approved in all states except for these listed. We will not be filing in the state of New York, so it will never be available there. California can take a while, so probably aren't expecting approval in California this year, but it will come. The rest of these states that you see, we are hoping to have approval here within the next couple of months. I know South Carolina is really close, so I'm hoping that we'll be able to launch there in May. As far as issue ages, our minimum issue age is 30 with a maximum age of 75. And upon issue, the initial death benefit limit is 50,000 with a maximum of $500,000. I already mentioned the premium payment options. Another differentiator is going to be when it comes to the risk class. Some carriers offer only a standard non-smoker and standard smoker risk class. We do offer 3 non-smoker risk classes. So we have the standard non-smoker, which is where, we know in a lot of cases you may just illustrate us there, and that's fine. But when you do receive back that health pre-qualification form from your client, and it's clean, right? They're healthy, not taking any medications, or maybe just taking the typical high blood pressure medication, cholesterol medication. Those are clients who are going to end up getting a preferred offer from us. So do keep in mind that even though you've maybe run a standard compared to our peers in the space, that when you have those healthier clients, they could actually get more benefits than what you're showing on a standard illustration with us. And then select non-smoker is just our nice way of saying somebody is substandard. So that's going to be up to a table 4 or a 200% rating with our select risk class. Now, we do offer a couples discount. It's very broad. With our couples discount, it can be just one spouse or partner applying. They can be married couples, same or opposite sex partners living together for at least 12 months, even same generation family members. So if you had a couple of sisters who are both widowed and living together, they would actually be eligible for our couples discount. All right, as far as benefit periods, we offer 2, 4, and 6, and you'll see the 4 is bolded because that's our sweet spot for pricing. I know that there's a couple of primary carriers out there in this hybrid space that are more have priced themselves most competitively at 6 year. So again, to differentiate and not look exactly like everything else that's out there, we went with the 4-year benefit period. Again, the point of that was focusing on the average claim. So depending upon what your resource is out there, the average claim out there industry-wide is somewhere between 3.1 to 3.8 years. So something under 4 is what we've targeted for our sweet spot and when it comes to pricing. Okay, so let's delve into a little bit more on how the benefits grow. So because we're on an IUL chassis, I'm going to focus over here on the right-hand side in this chart. You can see that we offer 3 different indexes. The select capped is the default index in all of our illustration systems. There is no index charge with that option. There's an 8% cap, 100% participation rate, and it does include a contractually guaranteed multiplier of 32%. Now, we went with a lower cap than what you would see with our select capped on our traditional life insurance products, simply because of the nature of the space. We wanted a more conservative illustrative rate. So we didn't want that default rate to be up in the 6% range. So in order to get that AG 49 rate closer to the 5%, we needed to go with that lower cap of the 8%. That's why you'll find that our multiplier that's included is higher than what you would find on our traditional life products. Now, the high capped is also available. It does have a 1.98% index charge on it. You will find that the higher cap higher guaranteed multiplier and higher illustrative rate. Where I recommend using some of the high cap is when you have those younger clients. So let's say clients under the age of 50. When they're under 50, time is on their side. Let's say you have a 40-year-old male who's a high income earner. He's got 40 years till the average age at long-term care claim, because that average age for a male is age 80. So I would definitely recommend putting maybe 25 or 50% of the allocation in the high cap when you have those clients under the age of 50. Just gives them more time to take advantage of what the S&P performance can be over that longer period of time, and therefore more growth and keeping up better with the rising cost of long-term care. The Barclays is our managed volatility option. Not expecting there to be a lot of allocation there, but if you do like managed vols and maybe use it on our traditional life side, absolutely it's there and available for you. And then I'd be remiss if I didn't point out our competitive rate on our fixed account. Our rate on that is 5.6%. And I do recommend, if you get some older clients, maybe over the age of 65, maybe putting 25% in it. Maybe once they, achieve age 75 or older, maybe bumping that up to where 50% of the allocation is in the fixed account, with the remainder of it being in the select capped account. So let's look at just a broad overview of how benefits grow in proportion to performance with the S&P 500. So remember, it's on an IUL chassis. So we have these indexes that are going to be a 12-month point to point. So in policy year one, we see the S&P was up, right? So positive performance. So what that means is the death benefit, which is the blue line here at the end of that segment, is going to receive a credit, right? So positive growth. The long-term care pool of money is always 2 times the death benefit. So it's growing as well as the death benefit. In the next year, you can see that the S&P point to point was down. There is, as I mentioned earlier, that lifetime guarantee, that annual benefit lock guarantee means that now since there was growth, it never goes back down. So that remains level. And then you'll see the next 2 years, there's positive growth. And so you see the S&P having an increase on the death benefit, and also hence the LTC benefits. Now, this next slide is my favorite slide or my favorite page from our illustration. It's included in every illustration. And what it is it's just 20-year back testing. The point-to-point time period we're looking at is December 14th to December 14th for each year. And you can see that in 2004 to 2005, the S&P index actual performance was 5.76%. Okay, now we need to add on our 32% guaranteed multiplier. So when you add that onto the 5.76, that gives us an actual crediting to the policy that would have been 7.6%. In the next year, you see the S&P actual performance was 12%. That's greater than our 8% cap in the select cap, right? So you take our 8% cap, multiply it by 1.32%, that multiplier, and that gives you the 10.56. So you can see that there's a lot of years where you have the 10.56 as you scroll down the column there. That's obviously all those years where the S&P performed higher than our 8% cap. You got a few years of zeros there where the S&P was negative. But what I really like to focus on is the average at that bottom line at the bottom of the screen, where you'll see that in real world back testing, actual performance credited to the policy, it would have been 7.51% average over that 20 years, not the 5.21% that we're illustrating, but 7.51. So at Hancock, we've always been very consumer centric. So the philosophy that we have on our traditional life products carries over on our LifeCare hybrid product, and that is under promise with the illustration, overperform with real world performance. So again, an extra 2% plus in real world crediting is what's anticipated, and therefore really able to grow the benefits significantly more than what you'll be seeing on the illustration itself. Okay. So let's move in and take a look at a competitive example. This is a female, age 55, doing 100,000 single pay. Now, we are using 3% compound inflation with our competitors in this example of Nationwide with their Care Matters product and Lincoln with their MoneyGuard fixed product. Now, I mentioned to you that they're most competitively priced with 6-year benefit period. We are most competitively priced with 4-year benefit period. And we really don't have a problem with you stacking our 4-year up against their 6-year, which is why I'm showing you that way in this example. So let's start over with the chart on the left-hand side. This is going to be the age 85 monthly maximum benefit amount, right? So that LTC monthly benefit amount after the growth. So you can see the nationwide growth at 3%, the Lincoln growth at 3%. And then the blue bar is our LifeCare product at John Hancock without engagement and vitality. The gold bar is assuming engagement and vitality at a gold level. So you can see that our monthly benefit has a decent advantage over the peers. What does this mean for your client? It means more options in the quality of care that the client's going to be able to receive, especially if they're receiving home care. Maybe they can receive more hours a day of home care because they have an extra $6,000 monthly to be able to pull out of their policy. Now, of course, if they don't need the full 21,000 in this example, they don't lose it, right? If they just need the 16,000, the extra 5 stays in the policy, and now the policy is simply going to last longer than 4 years. Okay, let's move over and look at the middle grid, which is going to be the age 85 long-term care pool, that bucket of money. Now, because it's a 6-year with Nationwide and Lincoln and a 4-year with us, we're not surprised that their pool of money is larger than ours, right? But interesting and noteworthy is the fact that if somebody does engage at gold, this client's bucket would have actually grown to be larger than what the Nationwide bucket of money is at age 85. Okay. Let's pivot over and focus on the death benefit now, because this is definitely a game changer, and we believe that you'll be able to move more cases to the finish line, meaning application phase, simply because of this feature right here. So at age 85, let's say that this particular client needs care for 2 years. And so she's going to accelerate her death benefit first, right? And let's say that over that 2 years, she pulls out $250,000 to pay for her long-term care costs. Okay. So that means that she still has $250,000 remaining in a death benefit payable to her heirs. Now, with our peers in that space, certainly, she's going to be able to collect the $250,000 for the long-term care costs. But because she's already accelerated the full amount of the death benefit, all that will be remaining is a residual death benefit, probably somewhere between 10 to 15,000. Okay, so let's add up the total that can be pulled out of these policies between long-term care and death benefit. With Nationwide and Lincoln, a total of between 260 to 270 between the LTC and the residual death benefit. But with LifeCare, even assuming no engagement in vitality, so the blue bar, at least $500,000. That's a meaningful and significant difference. So the most important question when you sit down to have a conversation with your clients about long-term care or longevity planning is to ask them what their personal experiences are with family members needing care. And the reason is that is how you're going to decide how big of a pool of money and which carrier to pivot to for designing the best plan to fill their needs and their expectations of what their care might look like. Because truly, that's how most of us decide. We don't have a crystal ball to know exactly how long we're going to need care and what, for what's going to cause us to need care, et cetera. What we base our decisions on is our personal experiences with family members needing care. So when you have those clients who their answer is, well, I have family members who needed care, but they needed care just for a year, 2 years, maybe even 3 years. Hopefully the LifeCare light bulb will come on simply because of this example that we just walked through right now. Because our death benefit is 3 times, in some cases 4 times more than what our peers is at average age at time of claim, they're going to actually have an opportunity when those claims are shorter term to be able to have death benefit remaining and therefore pull much more meaningful benefits out of the policy than they would with our peers. Okay, so let's take a quick look at how vitality can affect the benefits when somebody engages. Now, of course, we assume that you're going to run the illustrations with Vitality at bronze. That assumes that the client does not engage, and that way, anytime they do engage, it's only an added bonus onto the benefits. So you can see down here in the gray chart at the bottom that if somebody engages at silver, it adds about $30,000 onto the long-term care pool by age 85. If somebody engages at gold all years, it adds about just over $100,000 to the policy. So it's adding on by engaging at gold the same amount of premium that she actually put into the policy in year one. And obviously engaging at platinum gives even a little bit more of a boost. So again, it's optional. They don't have to engage, but we like to describe this as a three-pronged approach to longevity planning. We offer Vitality to motivate your clients to live a healthy lifestyle, therefore hopefully prolonging the day when they actually need long-term care, as well as the length of time that they might need long-term care, and also prolonging the age at which they would pass away. All right, so let's talk about paying benefits, claim time. The triggers are going to be the same that you're used to with any long-term care solution out there. It's going to be the 2 of 6 activities of daily living, or being diagnosed with a severe cognitive impairment that requires substantial supervision. We do have a one-time elimination period. It's 90 calendar days, and those days do not have to be consecutive. So let's look at a quick claim scenario as it relates to the indemnity and the reimbursement. So let's say that your client's approved for a claim and the monthly maximum benefit amount is $20,000 a month. Now, we will pay up to the IRS per diem limit for indemnity, which is $12,600 a month this year, okay? So if they're on claim this year, we would allow the client to receive that $12,600 on an indemnity cash basis. And then if the client incurs costs beyond that $12,600, then they simply submit receipts and we will reimburse the remaining $7,400 to them on that reimbursement model so that they still receive the full $20,000 monthly amount that they have available out of the policy. That's simply a consumer protection feature because, you know, you have this conversation with a client when they're 50 years old and they don't go on claim until they're 85 years old. They've probably forgotten what you've explained to them about what happens at claim time. And that is, you know, the IRS requires that all long-term care carriers send out a 1099 to the clients upon paying out benefits. And if it's paid out on an indemnity basis, they will actually have to file a supplemental tax form and claim those benefits. Any amount paid over the $12,600 that was not for tax qualified care is counted as taxable income. We don't want the client to receive any surprises, so we're doing the due diligence for them up front and protecting them from any surprises when they file their tax return. So we're just making sure that they are receiving the tax qualified care so that we can send them a 1099 where the box is checked and already tells the IRS that this was for tax qualified care. All right, and then we do offer concierge services through our vendor, the Helper Bees. They specialize in the aging in place marketplace, so that home care. So they'll send somebody out to the insured's home to do a one-on-one consultation, make sure the home is safe for them to continue to live in and age in place. So making sure rugs are tucked down safely so nobody trips, evaluating, you know, places where it would be helpful to install railings, ramps, even talk to them about, you know, home alert systems in case they should fall or need some medical assistance. They'll also give out home health care referrals, and some of those home health care providers do provide a discount because the referrals coming through the Helper Bees. All right, last section. Let's talk about the e-application and underwriting. So we are a digital application only. We do an agent check right up front just to make sure that the state where your application is and your long-term care certification for that state is all good and that you're appointed properly with John Hancock. That search will be complete by the time you finish all the different sections that you see down here on the left-hand side. If for some reason there was something wrong with your appointment, it just simply would save that information and stop you to where you couldn't send it off to the client for signature yet. The bonus of that is that you won't have to go back and get a new application signed in order to get the policy issued in case there was a certification that wasn't current. Now, we do require that an illustration be uploaded during the e-application process. You have an option to either say that it is signed or unsigned. I would guess that 99% of the time it is going to be unsigned, so just please be sure to mark that it's unsigned, and that way the illustration will get signed with the rest of the e-signature process. And then when it comes to underwriting, I already mentioned the 4 risk classes. This is designed to be a streamlined underwriting process. So there's no labs or paramed exams. If your client's under 60, they could actually potentially get an instant underwriting decision, meaning that within 30 minutes after the application is released to us, our metrics runs behind the system and would send you an email with the underwriting offer. Now, if they are 60 or over, we do have a cognitive screening requirement, which is pretty standard in the industry. It's a phone interview that's conducted by the vendor Illumifin, and it takes about 15 to 20 minutes to complete that. Now, we do have a quick quote mailbox specifically dedicated for LifeCare questions. So it's kind of the I've got a client, question, who is taking these medications or just had this surgery done recently, what risk class or how long do we need to wait before they can apply for this LifeCare product. And as far as moving conversations to the application phase, I already mentioned clients find value in the product that fits their experience and their vision for their own care. So please just ask that question about their personal experiences, and then, really think LifeCare when they say, oh, well, I haven't had any family members who have needed long-term care. Because of our meaningful death benefit, LifeCare is definitely going to be a product that they're going to find more value in if they're not envisioning themselves needing long-term care later on down the road, but their advisors recommending that, it's protected. Their assets are protected in the event that they might need long-term care. Also think about LifeCare when they say that the experiences are less than 4 years. Really going to be able to maximize benefits with both the LTC benefit and a remaining death benefit if they didn't need care for more than a year or 2. Now, we could be a fit if they did have situations where they needed care for longer than 4 years. There's a few cells where our pricing is competitive on the 6-year benefit period, but more often I've been hearing the example where it's an older client and the advisor is recommending using their RMDs as an opportunity to pay this long-term care premium. And when that's the situation, obviously they're going to want to pay more than just a single pay scenario. Since we don't have a cap on our 15 pay when it comes to the age, literally, since we issue through age 75, that 74 or 75-year-old could purchase a 15 pay design with us. So we do have that niche opportunity with clients, even if they do need a longer benefit period and bigger pool of money. If they are going to want to pay with RMDs, they can do that with us over that 15-year period. And then our niches from a pricing standpoint are going to be single pays, 4-year benefit periods, those healthy clients we talked about. Under age 55, again, simply because time is on their side to really grow those benefits in a more meaningful way. And those younger clients don't necessarily have to buy, the benefit that a 55 or 65-year-old is purchasing. So they don't have to purchase $6,000, $7,500, $10,000 a month benefit. Maybe they're starting with $2,500, $3,000 a month, $4,000 a month. They're locking in their insurability, which is important. And then with the S&P performance, they could actually grow that into a meaningful benefit by the time they hit average age at time of claim. All right, so that is my last slide. So Aaron, I'll turn it back over to you.
Okay. Well, first of all, thank you. That was a lot of information, a lot of great information. And I don't know, for the folks that are on here right now, if you're not selling long-term care, well, if you are, let me put it this way. I think you'll see right away that this is different. This is unique to the industry. It's you can see the value in a lot of different ways where there's just a lot more that your client can have than the other alternatives. So definitely keep John Hancock in mind when you're out there. We know that you can write for whoever you want. We chose to have John Hancock on here for a reason. So we believe they've got a strong product. They're a strong company. Everyone's heard of them. They've been in the long-term care space forever. Even they used to have a traditional product back in the day. So we're trying to really push this product because we believe in it. And again, the demand is out there, folks, and your clients are buying these. So last time I'll say it, We want them to buy it from you. So with that, I'll just open this up. If there's anyone that's not too shy to unmute, if you've got questions, the presentation itself is over, but we'll go ahead and stick around for questions for a little while. And if it comes into crickets, we'll just end the call. But so feel free to unmute yourself if you would like. Or I've also got folks, if you look at the bottom, there's a chat box. If anyone has any questions and wants to put them in the chat box as well, they can do that. Going once? We'll also have a recording for all of you that attended. I know we had some folks that I was talking with Ryan who sound checked me when we first started today, and he said that he had some folks, or he could hear people in the office that were calling in saying they weren't able to make it, and asked if we were recording this. So for those that are here, we'll send you out the recording, as well as for those that couldn't make it, so that you can go back and rewatch this stuff. I know a lot of times when we have these things, it's you don't retain as much the first time you watch it, so you can go back and get some highlights and maybe some questions to, or some answers to questions you might have had that you didn't want to ask or forgot to ask or whatever. So with that, again, folks, I'm at 913-568-2040. Kimberly, thank you so much for your time and your partnership, and we look forward to sending some applications your way. So thanks everyone for tuning in. Have a great rest of your week, and look forward to talking with you soon. Thank you.